Okay, good morning, everybody. It's 11 o'clock. We should get going. Richard's actually going to be doing most of the news this morning because it's all property stuff. But I'm going to be talking to Nicola Takada-Wood from ABI Japan Opportunity in a second. But first of all, I'm going to talk about M&G Credit Income first because it is one of very few funds that is issuing stock. And it's a reasonably small fund, but it's been quite successful. I mean, I know that chart doesn't look very exciting, but the main point of this is it's a debt fund that is designed to deliver a decent yield, and it's been doing that job. And after a sort of initial wobble where it went to a premium and then came back again and sort of stabilized, and it's been trading fairly close to asset value for most of the past 5 years. And more recently, it's been trading fairly consistently at the premium, and they'd be able to issue stock. So it's been reissuing stock that it bought back when it was trading discount. So it's now, I think, done all of that to 12.7 million shares. And it's got permission to issue up to another 31. And it knows that there's demand for it. And obviously, the pipeline to be a bigger, more liquid trust. So they're going to do a placing and a retail offer at NAV plus 1%. But because there's no stamp duty, that means that you're buying them probably slightly cheaper than you can buy them in the market, I think, at the current price. We won't actually what the issue price is until the 18th of March, because it's based on an NAV just before then. And then you'll be the last time you can apply for these is at 2 p.m. on the 20th of March. So, but if you wanted to apply them, you have to get the orders in sooner than that. And the results will be announced the 21st, and the new shares will start trading on the 20th. Now, the placing bit, I thought this was really interesting. I know there's a huge, great chunk of legalese on the screen there, but they're basically trying to avoid issuing a prospectus. Now, the required to issue a prospectus is so expensive and so confusing for everybody. Nobody makes pay much attention to it. It's a huge waste of time. Basically, what they've done is if you're an institutional, professional investor and you want to invest, you can't just put an application form in. You have to be contacted by Winterflood. So they will have a list of people that they already know have got demand for these shares. And then basically they sign their life away, say that I made this decision by myself, nobody puts me to do it. And somehow that avoids the need for prospectus. So I know this is what the market should be like almost all the time. If you're going to buy something, you do the due diligence, you make sure that you're happy with the risk involved, and it's on you if it goes wrong. The world would be so much more simpler if that was the way it just worked. So this is the old sort of Latin carry it until Bible ware stuff, which is the way the market used to work many, many years ago. And there's been so many protections built into it now that it's just become staffed. So this is a way of getting back to that old situation. For the retail investors, Winterflood has, I think, got a wrap platform. And the details are exactly the same as they in terms of the price and the timing and everything else. And retail investors, minimum size you can invest is £100. But the maximum size of the retail issue is only €4 million. And this is one of these daft EU rules that we've imported into the UK and we've done nothing about since Brexit was years and years ago now and still haven't got around to changing. And this must change soon. But the €4 million side is, again, it's the trigger where you need to do a prospectus. So that's what their cutoff is there. But because that number is quite small, there's quite high chance you might get scaled back. And there's nothing you can do about that, unfortunately. There's no way of guaranteeing that you get a bigger share than anybody else. So anyway, go for it if you want to. We're not advising one way or the other. I did write about it for Questa a few weeks ago, and you can try and read that. So I'm telling our site behind a paywall. But I'm going to now hand over to Richard to talk about the property stuff.
Thanks, James. Yeah, so another busy week. So a month ago now, I was on the show talking about Assura, who had a bid from KKR and USS, which was rejected. So KKR have come back now with a different partner, Stone Peak, another US company, and put in a bid at NAV, which, well, just below if you take away the dividend, which is included in the price. which the board has said they're minded to recommend if that offer is firmed up. And then at the same time, Primary Health Properties, which is another UK listed primary healthcare property company, does exactly the same as Assura. And I think I did mention when I was on the show last time that it would be interesting to see if they come in for a merger, and that's exactly what's happened. So they've been in contact with the board to talk about a merger opportunity. Now, Assura says that what they've been talking about would value them at 43p, which is obviously well below the KKR bid. But PHP came out and said, actually, we've not really discussed the conversion ratio and things like that yet, and they seem really keen on doing a deal. So we'll see what happens there. It would make sense. Obviously, it's been sort of touted for a number of years that these two combine. It'll be a huge portfolio, so you get sort of cost synergies and all that from there. A reduced cost of capital and the strengthened balance sheet as well, and obviously being a much bigger company, there'd be increased liquidity in the shares and things like that. So there'd be massive benefits for both shareholders. So like I said, so the portfolio would be about 6 billion. The NAV will be just under 3 billion, market cap just below that. So be a sizable company. So PHP has until 7th of April to make a firm offer. So I suppose watch this space really to see what happens with that. And the shareholders will have a decision to make, I suppose, whether they want to cash out now or carry on in a bigger form. So another REIT, Care REIT, see what's happened there. On the right-hand side of that chart, it's spiked up the share price. You see the NAV there, that's the orange line, it's been really sort of consistent since it started. And that spike up has been because this week they had an offer which has been recommended by the board, so just under 450 million from Care Trust, which is a US listed REIT as well. It's massive, sort of 5 billion market cap, and it transpires that they've sort of been looking to come into the UK sector for a long time. Been searching around for deals and things like that, and they first approached Care REIT at the end of 24, and they've been in sort of discussion since on a deal. So that's coming at 108p per share, which is a massive premium to the share price, because this has been trading at a big discount. But it's also almost 10% discount to the NAV, which seems quite a lot that's been sort of left on the table there by the board. And it was funny, actually, because that was announced on Tuesday, and then 2 days later, Care REIT had their annual results come out, and they were pretty good. Like I said, very consistent since it launched in 2017. So portfolio value is now worth sort of 680. The rent roll has been going up consistently because all their rents are CPI and RPI linked with a cap on that. So they've been sort of nudging up very consistently. NAV's grown since it launched from 98.2p to now just under 120. Dividends has grown from 6p to 2p, and the annual NAV total return has been 9%, which is pretty decent considering what's gone on in the last few years, especially. And I just picked out a few bits from their presentation from their results. Like I said, so top left there, you see the accounting return for year 9.4 this year, 9 in total average since it launched. Rents ticking up every year, it's now just over 50 million. And then the bottom one is rent cover, which is quite a crucial thing in the sort of care home sector. This just shows the affordability of the rents that the care home providers pay Care REIT, and how much they obviously charge the underlying tenants, and that is 2.2 times, which is very good, and that you can see again it's been ticking up over the years as well. And then I picked out a couple more on the tenant side of the business on the next slide. So the top one shows the bed occupancy. So it starts at around early 2020. So you see the impact that COVID had on the care, on the the care home sector. And then that's just been grown, and now it's back up to pre-COVID levels. So normalized levels, sort of high 80%. And then the bottom graph shows, so the bars are the average weekly fees that they charge the underlying tenants, and that's obviously been going up. The top line is the rate it's been going up at, and the bottom line is inflation. So you can see that they've been able to charge tenants above inflation rates, and that's because of the demographics in the sector. So we all know aging population, supply and demand of this isn't great either. So you have this sort of weird juxtaposition of actually the board and the manager said they're going to vote in favour of this, and then 2 days later coming out and saying how brilliant the sector is and how brilliant the portfolio is, which I agree with, and yet they're recommending an offer that's 9.4% below the NAV. For me, it doesn't make sense, and we'll see what shareholders think of it when the general meeting is announced and they get to vote on it. It needs 75% shareholder approval. We'll see if that happens. To my mind, it's a lot of value being left on the table there, but we shall see. So urban logistics, just quickly, I was talking about them last week when they announced plans to internalise their management. And this was sort of one of the companies that had been touted as a target of Achilles, which we again talked about a few weeks ago when they launched. So it's the guys behind Harwood Capital who helped with hypnosis, and they're behind the strategic review at PRS REIT as well. So they raised 54 million. They're looking to go into, as an activist effectively, and go into companies that are trading at wide discounts and try and get value there through lots of different avenues. So this seems to be their first target. So Urban Logistics REIT, they now own 3.2% of the company. And we shall see how they're going to engage with the board and see what kind of strategies they're going to look to sort of bring that discount in. But it obviously set out the rumour mill because the board felt it needed to come out with a statement this week, just saying that speculation on corporate activity, and there's not been an actual approach or anything like that, and they would make an announcement if there was. So we shall see what happens there. Be interested to see what happens. And then Life Science REIT is the last one we'll talk about. So they've had a really tough time. It was the last REIT to launch actually before it all sort of started going south at the end of 2021. And they've struggled ever since, really, which that chart shows the sort of discount is now 50%, which obviously isn't great. So they've announced this week that they will launch a strategic review. They'll look at all options: sale of the company, managed wind down, look at consolidation, or even amend their investment strategy. It seems like they want to sell. I'm honest, because they've talked about, they've had a number of discussions with potential suitors, and they believe it's a sort of attractive business for parties to come in and bid for. So again, we'll see what happens there. Just on the next slide, sort of go through what's happened with this company. So yeah, like I said, it launched in late 2021, and it's focused on the Golden Triangle, they call it. So that's between Oxford, Cambridge and London, and it's really where all the life science companies base themselves, obviously, for the talent coming out of the universities there. And the premise was to provide the lab spaces that these companies need. And also one of the things that they could really get advantage from is converting office space, which, as we know, has been sort of under the values of the rent that you can get on that is sort of been depressed over the last few years, and convert that into lab space, and then let that out at much higher rates and get a really good, decent return on their investment there. in the development and refurbs and things like that. It just hasn't panned out that way. There's been lots of issues, and they obviously, as soon as they launch or a few months later, the interest rates went sky high, and they've not been able to. The share price went to a discount, and they've not been able to raise any more money or do any of the things that they wanted to do. And also the life science sector has also sort of fallen back a bit. The venture capital funding's fallen back a bit since the post-COVID high. So the demand side is still there, but not as strong as it was. And like I said, they've not been able to fulfill a lot of their the strategic promises from the start. So we've seen the discount widen to, like it is now, 50%, which isn't sustainable. So we'll see what happens here. I would imagine that someone will come in with a bid and get a nice sort of premium for where the share price is at the moment, hopefully. Thanks.
Thank you, Richard. Yeah, it's a shame they're all disappearing, these funds, but there we go.
Right.
Great. So that's enough on the news side of things.